Hello, everyone, and welcome to the second of our live streams. Apologies for the slight delay in starting. As usual, David and I are just stumbling around the technology. So we do appreciate you being patient with us. As we always say, we don't find it stressful trading. Charts don't phase us at all. Fast trading doesn't phase us at all, but we always seem to stumble with sort of simple technology. But never mind, here we are. As I said, thank you so much for taking the time to join us. And a bit of an unusual session in that we are at the end of the trading week. And one of the reasons we wanted to do it at the end of this week is because markets have been certainly on a bit of a roller coaster since the 5th of August. So we just want to sort of go over that and look at look at them through the prism of volume analysis and what they've told us, what are they telling us, and more importantly, what are they telling us about what's likely to be coming downstream in the next week or two. I also had had various requests, as some of you who were with us last time will remember that I said, well, if you've got anything in particular that you want us to have a look at, just drop me an email at anna@annacooling.com or drop me a little message on my Twitter feed, and we will certainly take a look at what it is that you are particularly interested in, and we will certainly feature it in the live stream, because obviously if it's of interest to you and you have a particular question, you can be assured that there are other people who are also interested as well. And and it makes it much more interactive and for us much more fun. One of the requests was actually to look at the NDX, the Nasdaq. And in fact, funny enough, that was going to be the topic this week anyway, because it's really, really interesting from a VPA perspective, the charts, particularly what happened just prior to the 5th of August, and then the price action that we had on the 5th of August, and what is happening at the moment. I'm going to look at that. I think David's got, are you looking at Apple? Absolutely. Apple stock? Yeah, David is looking at Apple stock, and lots of VPA lessons on there as well. And I'm also going to mention the 13F filings, which were released, I think it was yesterday or maybe the day before. These are quarterly releases, and essentially large hedge funds, large institutions that hold very large stakes in companies are obliged to report their stake. They're obliged to say whether they've sold or whether they've bought stakes in new companies. It's people like Warren Buffett, people like Stanley Druckenmiller, Bill Ackman, the kind of names that you come across every day in the media. And the reason it's important is because it's the first time we get a chance to have a look at their portfolios and to see what they invested in. Now, admittedly, it's the previous quarter's data, but traders and investors pay very close attention to what these guys are doing, particularly if they take new positions. And there've been a couple of stocks that have featured for the first time, certainly in Warren Buffett's portfolio and also in Bill Ackman's portfolio. And I had a quick look at the charts, and all I can say is if you look at the charts and you know what you're looking at from a VPA perspective, it's really very, very interesting. So that's what we've got lined up for you in this session. And of course, if you've got any questions, please just drop them into the chat box, and David and I will be more than happy to answer them for you. So before we start, I just pass you over to David.
It always helps if I unmute the video, of course. Just to reiterate what Anna said, it's great to have you here, and it's nice to see so many people joining as well, so it's wonderful. This is our second live stream event, so please bear with us on the technology. We may be a little bit slow in changing between the two of us, in changing screens. So if you can just bear with us, we will speed up because we've done GoToWebinar for years, and I'm sure the first one was awful, and probably much like this was as well. So please bear with us, and we will get up to speed. What I'm going to show you we're staying on TradingView because not because we think it's the greatest platform in the world. Although it is very good. We also support NinjaTrader, MT45 TradeStation. So we have plenty of other platforms. It's simply because we're actually on Mac at the moment for these sessions, which has inbuilt cameras and all the rest of it, and we're running on Mac. And as I'm sure you know, TradingView is a browser-based platform. It is very powerful. We do like it, and we do, in fact, encourage all our mentoring students. I know someone's asked about the mentoring, and I'll answer that question in a moment. We encourage all our mentoring students to use it because it is very straightforward, and the coaching sessions that we run, it's not a question of us chalk and talk, in other words, talking to you as a student. It is very much screen sharing. So we encourage all our students to share their screens, and we find that on TradingView it's a great way to do it, and a lot of students run it anyway. So it's a very, very good platform. I'm going to pass back to Anna, and we will get going and start looking at some charts as well.
Okay, just going to start sharing my screen. Here we are. Okay. So the first chart I want to have a look at is the daily chart for the Nasdaq, because as I said, all the NDXs. This is one that we were asked to consider, and as we can see here, it's obviously back in a nice uptrend, although some of the volume that we can see here is slightly below average. And one of the things we have to always remember about volume is that there is also a seasonality factor to it. We are in the middle of August, traditionally a very quiet time in the market, although the last week or so it's been far from quiet. It's certainly not been a quiet period at all. So to see a slight drop off in the volume is not unusual or unexpected. David and I remember summers that were end of July, whole of August, and it really wasn't until Labor Day and most people were back at their desks that activity used to pick up. It hasn't been that way for the last few years for various reasons. We had COVID, and the markets have certainly been lively, to say the least. What's also interesting is in the uptrend, so we do expect a slight drop-off in the volume because of seasonality. Obviously, rising prices and falling volume is never, it's always a bit of a red flag, because that's not what we want to see. It's one of the basic tenets of volume price analysis, the price action and the volume. The volume should be proportionate to what you see in terms of the range of the candle. What is also interesting is when you get an uptrend like this, or any trend with an uptrend or downtrend, is another way you can kind of judge whether it's a healthy trend is, do you have more volume on the up bars than you do on the down bars? And as we can see here, we have very, very narrow spreads on the down candles, as we see it, reasonable volume, but nothing seems to happen. There's no fall, and that is also, it tells us that certainly the prices are being maintained. That that there is no selling pressure. But what I really want to go, so this is where we are at the moment. The volume market hasn't closed yet, so we can't judge whether today's volume, this is going to be the final, the final figure. We will have to see. And the question is, well, where is this index looking to, where is it going? And the obvious point is it obviously wants to go back and test this 20,500 level, the all-time high. But that's the point that I want to have a look at the moment, because what we're seeing at the moment is we very rarely get it. We do see it, but normally when you have a big fall, a correction that we had from this bearish engulfing candle that we have here at the when we had that topping out, as it were, of the rally that was going up with the NDX, is when you come to a point where you look to have a reversal, you don't always get what we call this V-shaped reversal. You'd get the stopping volume coming in, then you get a period of consolidation, accumulation, and then back it goes up again. But it's just been the nature of the markets in the last week or so that we've had some, as I said, some very dramatic price action. It really has been a bit of a roller coaster. But if we go back to this candle here, and I may have mentioned it last time, I certainly mentioned it in posts on my Facebook page, and I've certainly mentioned it a number of times on my Twitter feed. A bearish engulfing, or the engulfing candles that we have here on good volume, high volume, above average volume, is a strong signal. It's one that we need to pay attention to, and statistically it has a very high probability of playing out. What normally happens that we see here, it also triggered what we call our volatility candle, because the price action was outside of the average true range for this particular time frame. You normally have a reversal back into the spread of the candle, a little bit of sideways consolidation, and then that candle, the high and the low of that candle, then provides you with your resistance and your support. And once one of those is breached, you will know whether that candle is going to be validated. That particular candle pattern is going to be validated. And what happened here, as we can see, back into the spread of the candle, a little bit of sideways. We had some volume coming in under those candles. Didn't go higher, certainly didn't go lower. So there was obviously, whenever we've had pullbacks in the NDX, in the Nasdaq, and in the technology stocks, traders and investors will come in and buy the dip, as it were. It's been a feature of markets certainly since last year, basically middle of last year. So it's no surprise to see the price holding up, as it were. But once the low of that candle was broken, that's when the down move really got underway, and it was punctuated by volatility all the way down. Had a bit of a pause in July, sideways, attempted to rise. Then we have another volatility candle, and down we went again. When you have, as you say, well, how is there any way that we can somehow anticipate, not predict, anticipate that we would be seeing something, particularly when a market or a stock comes to an all-time high? And this is where we have another facet of VPA, where we have rising prices. We can see narrowing, the spreads are narrowing, but the volume is kind of flat, as it were. So yes, the prices are going higher, but they're not really being supported with a lot of enthusiasm in terms of volume. And I think that's the best way I can describe it, with enthusiasm. And don't forget, July, beginning of July, I know we're coming into summer, but it's still a fairly active time in the market. So the market's looking a little bit tired. And that's another time in the phase of the price action that perhaps we should pay a little bit of attention, saying, yeah, it's been going up, it's been drifting higher, but maybe something is going to happen. It was the Thursday. I think, I can't remember from memory, I'd have to go back and look at the economic calendar, but I have a feeling that there was either a CPI or it was after the FOMC. I'd have to go and check. There was a trigger for this candle and the beginning of the subsequent reversal. And that's what normally happens. Markets look a bit tired. They look a bit, they're just drifting higher. There has to be a reason. And this is a classic move by the market makers, by the specialists who run these markets. They will use every bit of news, be it fundamental news, be it geopolitical news, be it central bank news, that will be an excuse either to move it higher or to reverse it. And this is why sometimes, markets, they're bullish, but they go down on good news, and they're bearish and they go up on bad news. You have to remember the news is there as a means for more manipulation, for if you like, trapping traders, drawing them in, and then doing the exact opposite. So that's, as you see, lots of volatility on the way down, a lot of momentum. But if we compare that with the move higher, if I just shrink that down slightly, okay, so this is April to, July. It was going higher. Look at the range of the candles, no volatility at all. Compare the difference when markets move lower. And the reason why there's volatility and there's momentum in markets moving lower and stocks moving up is because the market makers want to get it to the point that they want to get it before reversing it. They don't want to hang about. That's why markets grind higher, but they always move much faster when they're on their way down. So now I want to come to try and explain, well, they want to move it down quickly, but they don't want to frighten everybody. If you remember on the way down here, news was coming out, news about recession, news about, well, the Fed wasn't going to cut any more, the interest rates, we weren't going to seeing interest rates. There was, because the price action moves against this backdrop of 24/7 media and news items, Fed speeches, etc., etc. There's so much news, sometimes we can be overwhelmed by it. But we always have to look at what is the price action telling us and what is the volume telling us. And this is where it becomes really interesting with this particular down move. We can see here, it doesn't go down in a sort of classic waterfall. It falls, attempts to rally, goes down again, goes sideways, rallies, falls again. And then we come to Friday, the 2nd of February. And I'm just going to expand that. And the previous candle was another volatility candle, and the rule is, as always, are we going to see a reversal back into that candle, and a consolidation, and the high and the low then become the significant support and resistance levels. This was the Thursday. What happened on Friday? We had a gap down. The session ended with a very, very narrow, tiny little candle here, very small doji. But look at the volume underneath there. Look at the volume, and that is significant. Now, forget what happened on Monday. There's that specific reason for Monday. But when I see a signal like that, where we have this tiny candle, and you see them also at the top of trends, at the bottom of the trend, and a ton of volume going there, my eyes sort of light up, because I think, there has to be stopping volume in there. That is coming to a point where if that were all selling, that candle should be down there. It's not. So there has to be stopping, but there has to be buying in there. So maybe this bearish engulfing candle, this signal, is now coming to a pause, at least, if not a stop, at least a pause. And we would be it's a perfectly reasonable expectation that this is coming to as I said, a halt, if a pause, if not a halt. But look what happens on the Monday. It carries on. It did actually carry on lower, although it closed higher and reversed with a lot of volume. And you say, well, why did that happen? First of all, that is just one signal, and one of the mistakes that David and I made very early in our careers with using volume price analysis is that when you see very strong signals and you know that they pretty much always play out, like the engulfing candles, like the shooting stars, like the hammers, and like these anomalies, we can get a bit carried away. We think, that's it. This is what I've been waiting for. And we can jump in a bit too quickly. So a little bit of patience, and which is difficult, particularly when you know, because we've been doing it for so long, this is going to reverse. It's just, it's not a matter if it's going to reverse, it's a matter of when it's going to reverse. But Monday did go down, but then carried on higher. Now, if you think back to the news over the weekend and the gap down, and also what happened was, this was the Bank of Japan. This is one of those drivers that have been lurking in the background for markets. It's the carry trade. If you want to read about it, then just type in yen carry trade and you will get a whole raft of articles on Google which will explain it in more detail. And the yen carry trade works very well when the Bank of Japan interest rates are very low, but as soon as there's any hint that they're going to go higher, it will cause an ocean of pain to institutions and hedge funds who have borrowed at very, very cheap rates to buy higher yielding assets. But that's not just outsiders, that's also the Japanese themselves. That was the scare of the Bank of Japan. But clearly, I can't remember if the Bank of Japan or the Ministry of Finance for Japan actually came out and calmed the markets. And you have this big, significant reversal. Although you've got a wick to the top of the candle, you have got a lot of volume. And in fact, we can now say with confidence, because of what's happened subsequently, that is the bottom of this correction lower. So the 5th of August is now an important level on the NDX. And as I said earlier, it's now been steadily going higher. And as you can see, no volatility. We've had nice up days, narrow days. We've had these 2 down days, but look at the volume and appreciate it's August. And the question now is, well, where is it going? Well, it's come up to this sort of resistance that comes over from this consolidation here. If it gets through here, then there's no reason why it can't certainly look to retest the high from this bearish engulfing candle. And what we have to look at now is, well, what is likely to happen in terms of news? What's going to happen? What's going to be happening between now and, say, Labor Day, when the market's really, the activity, the participation level increases. And that is, we have Jackson Hole, which I think is next week, and it's the symposium and the central bank of getting together, and we'll see what Jay Powell has got to say. So that's what I wanted to say about the NQ. If we just look at the weekly very, very quickly, what have we got here? As I said, we haven't quite finished with the volume, and in fact, we have a perfect example of this little tiny candle. You've had the run up. Look at the volume under that week. That is an anomaly. Then you have this with very high volume. You have this tiny, tiny little candle. Wyckoff's third law of effort and result. If that was, okay, it's a red candle, but it could easily have been a little green candle with a ton of volume underneath it. And what happens? It should have been higher. And that is another warning. And we have 3 black crows. There we are. I mean, obviously, with the weekly charts, you do get the smoothing out. You don't see the gaps and the daily chart can be, very noisy, particularly with the stock when you have earnings. But the weekly chart is certainly one to always to pay attention to. At the weekend, just look at the dailies, look at the weeklies, even look at the monthlies, because I've got a stock where when we look at the stocks from one of the stocks from the 13F filings, the clue was actually in the monthly chart, if you know what you're looking at. And what we have here, we have, as I said, these are normally called three black crows. They're bearish. If you were just a price action trader, you saw three really nice little candles, and you think, oh, that'll carry on lower. Now it did carry on lower, but look at the volume under that one. Do you see? It's an anomaly. If that candle based with that volume should be down there, so that was already telling us something on the weekly chart. So I hope you enjoyed that. I'm just going to pass over to David. Please put your questions into the chat box, and I'll come back with as I said, with the 13F filings. I've got some nice visuals for you to have a look at, that you can go and see a breakdown of the portfolios of the 15 people, hedge funds and institutional traders that the market tends to pay close attention to, and then I think I've got something else, but and I'll have a look at some charts as well. There's two charts that I mentioned, so I'll just stop sharing. That's it. Yeah, that's fine.
There we go. Took us a bit of time, but got there in the end. Hopefully you can hear me. I've unmuted myself, which many times before I've not done, and happily spent the next 10 and 15 minutes talking to Anna and myself and the dog. It wasn't very helpful, but there we go. I've got two very simple workspaces set up. One is the triple Qs, and these are on fast time frames. So we've gone from what Anna was looking at, which is much lower time frames. Now, the point I would make to you, and first of all, before I forget, the data feed here, it is on delayed. We don't use live data on TradingView. We use it on other platforms. So bear in mind, this is delayed, but from a teaching perspective, makes absolutely no difference whatsoever. I'll still talk to you at the live edge of the market, even though I don't know what's going on 10 minutes out, if you understand what I'm saying. So just to make the point, because I think someone picked that up last week, yes, it is delayed, not for any particular reason. It's just we don't subscribe to live data on this platform. I'll make the point that the reason that fast timeframes, it's not the case that can you make more money trading the faster timeframes. There's no right or wrong way to trade the markets. And indeed, the students we have on the program really range from literally from the investing perspective of daily and weekly right the way down to very, very fast charts. Those of you who know us well, you'll know that I'm very comfortable with 15-second and 30-second charts for intraday scalping, which I use frequently. I don't find that an issue, but I'm sure some traders would. That's what suits me, and it also suits some of our students who are quite comfortable with that. I find it keeps my brain sharp, and it also keeps my VPA skills really on top of that. What I would urge you to do is, if you are relatively new to volume price analysis and you are trying to learn this methodology, by all means use those fast charts for learning. And this is one of the reasons I've pulled this up. It's not, I mean, the price action isn't going anywhere particularly at the moment, but I will highlight one or two things for you, which really encapsulate, oh, almost disconnected me, which really encapsulate the beauty of the methodology is many, but primarily it's something that can be applied to any chart. So the analysis that you might do here on a 1-minute chart would be identical to the analysis that you would do on a 1-month chart as an investor. So you literally go from scalping at one end to investing at the other, but the methodology is identical. The analysis that and the conclusions that you draw from it are precisely the same. It makes absolutely no difference. The other beauty of it is this is QQQs. We're on the triple Qs. This could be a gold chart. It could be a currency. It could be a currency future. It could be another index. It could be a commodity. It could be a stock. It could be a bond. It would make absolutely no difference to the way you read your chart. It's identical. And I've said this to many of the students. Show me a chart without the ticker and I'll read the chart. And that's really what it's about. So the key takeaway is that once you have learned this methodology, you can take it away and do whatever you want with it, whatever market, whatever time frame, whatever instrument. And the other beauty of it is it provides your foundation. It is the foundation stone of everything. And if you have a solid foundation in place, it's like building a house. You're not going to build a house on sand. You're going to build it with solid concrete piles, foundations, reinforcement, everything else. Once you've got that in the ground, you will then build your house. And trading or investing is exactly the same. If you don't have a solid methodology in place and a really, really good understanding of that methodology and the ability to read charts very well at the live edge, you will struggle. But the beauty of VPA is that once you have that, you can apply it across the time frames. And in addition to that, if you have an existing, I don't know, group of indicators or an approach you like, maybe you like Fibonacci or you like Elliott Wave, or you have particular indicators that you're very keen on, you can plant them on top. Indicators are there as a support mechanism. They are there to provide additional information that would otherwise be difficult to get in quickly or difficult to find. And that's the approach, and that is the concept, if you like, and our whole approach to how we coach and how we teach. So it's all founded on volume price analysis, which comes out of Wyckoff with the three laws, which Anna referenced. And this all really goes back to tape reading. If you go back to, and I'm sure you've read it, or if not, I would urge you to read it, Jesse Livermore, iconic trader. How did they make their money, these traders? And they were using the ticker tape. And if you boil it down to what they were looking at on the ticker tape, it was really only those two things, price and the number of shares traded. That's all they had. It was a piece of tape. And from that, and the way the price was reacting to the number of shares that was printed alongside, they were able to interpret from that simple piece of tape what the potential direction of that stock was likely to be. For us, it's so easy. We have electronics. We have it all in front of us. It's so straightforward. For them, unbelievable when you think about it. Now, when you look at a chart like this, I always say the first thing your eye is drawn to are the volume bars, which are extreme. And we've got several here. I won't go through them all, but that's what happens when human beings are great at spotting differences in groups. If you walked into a room with a party where you've got maybe 100 people, you've maybe got 2 or 3 very tall people, but you've also got some short people. And you won't look at the average, but your eye will be drawn to those very tall people who maybe stand head and shoulders above everybody else. You can't help it. It's a natural reaction. But our eyes are very good at that. We are very good at discerning very extremes, if you like, very high, very low. And it's exactly the same here. So what we look at is we'll look at the highs first. And let me just pick up 1 or 2 examples for you. If we start with this one here, let's take this as an example. If you look at the spread of this candle, it's pretty normal. I mean, you've got quite a few of them here. Look at this one here. It's identical, I would say, pretty much. You've got little wicks top and bottom. You've got little wicks top and bottom. So if you compared those 2 candles and said, well, we're in the session here. We're in a 1-minute time chart. So we haven't got to worry about session crossovers. Are we comparing like with like? Are we comparing apples and pears? No, we're not. We're comparing apples with apples here because we're on a 1-minute time frame and we're in the US session. So there's absolutely no reason why we can't consider that piece of price action as a benchmark against which to judge this piece of price action. Now, clearly, there is something anomalous about that because we've got the same spread of price, and yet the volume associated with it on this one is hugely different to the one, the one associated here. It's more than double. So what does that imply? It implies that there is an awful lot of effort going into this candle, and yet it's not resulting in what it should do, assuming that this is our benchmark. Because if this were the case, then on this candle, we would expect to see the spread up here somewhere, and it's not, it's down here. So what is that actually telling us? It's telling us that the market makers or the big operators, depending on what market we're looking at, there is a lot of effort going in here, but the market is not responsive. In other words, there is volume going in, but that has not resulted in a genuine price move. So the market is starting to look a little weak at this point. In other words, the market makers are forcing volume into the market, but the price is not reacting. So there is weakness. It's a first indication of potential weakness ahead. It doesn't automatically mean that the market is instantly going to roll over, but it's a warning signal. It's telling us, pay attention and just read the chart and see what happens. We move on. Now, at this point, we might think, oh, well, maybe that was a false signal. Maybe we didn't read that correctly. You've got to remember with VPA is that one of the key things is, and Anna mentioned it, that when you see a signal and a big signal, a big surge in volume like that, it's very easy to react instantly and immediately go short on this occasion, as you would expect. But you've got to remember that everything takes time in this business. And the analogy I've used many, many times before is of a tanker, which is underway. If the engines are switched off, that tanker will have its own momentum. Not a great analogy, but I'm sure it makes the point. So there's always, or very, very often, you will see a very strong signal or a group of signals. The market doesn't react immediately, but it will do in due course. You will often see congestion phases following, particularly in downtrends where you've got accumulation or you've got distribution in the uptrends. So we come to this candle, which breaks away from this little congestion phase, and we look at that one and we think, well, this looks a little bit odd now because the price spread on that candle is greater than on this one, and yet the volume is back to less than half. So now we've got the reverse occurring where we have a big move in price. I say big comparatively, we're on a 1 minute chart, but this could be a daily chart, could be anything. So we've got quite a big move in price, and yet there doesn't seem to be sufficient volume. If we assume that, this volume here was extreme, this has gone the other way. Now we've got a price move that doesn't seem to be supported with the correct volume, and it isn't. And what's happening here is the market makers are moving this price higher to draw traders in on the premise that the market is now breaking higher and is going to develop a further bullish trend upwards, having broken through that, what could be considered minor resistance here, we've now broken out. But that breakout is not a genuine move. It's broken out on false volume, if you like. It's an anomaly. We then move to the next one in this sequence. What have we got? Well, we've got a very similar thing where we've got a spread of price action, which looks out of balance. We've got very high volume going in again, and this is really the market makers again. It's the last hurrah in this little mini rally, if you like, where they're forcing volume into the market. The market is relatively weak, and then we start to get the development of the downtrend, which is now taking shape. Not hugely. We're not talking about a price waterfall here. We're talking about moving down into congestion phase. And the nice thing with this, Anna and I spend a lot of time looking at congestion phases, simply because you might find that curious, but I can assure you that's what we do, certainly on the faster timeframes at any rate, because congestion phases are where trends are born. And in addition to that, they provide these wonderful channels of price action where you develop very strong ceiling of resistance, very strong platform of support, which then defines any move away. And secondly, Or secondly, it also gives you a very clear position to set any stop loss. And thirdly, and more importantly, it gives you a natural barrier of price protection, as indeed occurred here had you gone short, where the market reverses, it rallies, it bangs into what was a support, has now become resistance at that level, and it gives you that protection. So if your stop is up here, you have this natural protection. And that natural protection was not you saying, well, I must have 5 points or 10 points or whatever it may be on your risk of money management. It is an area of protection that has been designed and developed by the market itself, and therefore will have much more validity than any number that you may choose or an area you may select. So congestion phases are just absolutely key to understanding price action. And remember that markets spend 70% of their time in congestion and only 30% in trend. So you've got to pick them out. It doesn't matter where they are. And the only thing you need is patience. I know none of us are very good at being patient, but I can assure you, if you can be patient and wait for those moves away. And breakout trading gets a bad press. The reason it gets a bad press is because most breakout traders don't use volume and therefore get trapped when you do get fake moves with the market makers moving one direction and then reversing again. So there we go. Yeah, hold on a minute. I'm just going to switch off. I'll let Anna answer a couple of questions on air. So I'm going to mute myself, try and do this as seamlessly as possible.
I just want to answer a couple of questions directly, rather than type them into the chat box. So I'm just going to go back to my screen. On that one. Right. One question was just refresh about anomalies. How do we know which direction the market is going to go? Well, it depends where the anomaly occurs. So if we go back to the weekly chart, I can use the one chart to answer both questions. If we look at this anomaly here, where we had this move higher, and we had the rising volume, but we can see here prior to this anomaly, we had an anomaly because we've got lots of volume going in, price wasn't going anywhere, lots of volume going in, price wasn't going anywhere, just over half the volume, little tiny candle. So we know something is going to happen. That it is, you could say, well, why didn't it reverse here? That's the first signal. The second signal, as I said, this is where patience does. You have to be patient, and this is a particular candle volume anomaly that I do like. Yes, we had it here as well, but it didn't quite roll over. And when it finally does here, it comes at the this is very much the top of the trend, and that is telling you that it's likely to reverse lower. And you get these at the bottom as well. So the anomaly, it depends where it is. If it's for a reversal, if it's at the bottom, you're looking market to reverse higher. If it's at the top, you're looking at to reverse lower. Somebody then asked about stop losses and what you would do on how would you use, say, the weekly chart. And the weekly chart is really to try and give you some sort of insight into what is likely to be coming up next week. As I said, we could see this, we saw this happening, we saw the volume rising, then we had these 2 weeks. Those 2 weeks must have been absolutely hellish to actually trade, because you have very, very, very narrow spreads and you've got a ton of volume going in. So if you're on the faster charts, very difficult trading environment the whole of that week. Then relief, because at last you got a decent range in the week. But that signal will tell you that this was probably a bit of a false dawn, and also really confirming what had been happening the previous 2 weeks. And this was, for me, this was the final confirmation. And really, in terms of where your stop loss would be, and if it is a new verse, it would be there. As David said, you use the levels that are created by the market to tell you where is the best place to put your stop loss. Is that pretty much, David? Is there anything else you want to add to that, or you're happy with that? Yeah, okay. So I hope that answers both those questions, and I will pass straight back to David.
Yeah, I just unmute myself. There we go. And just get the share screen back. There we go. There we go. Okay. Where were we? So we're still on triple Qs. I will hop over onto Apple as well. I've got that on multiple time frames too.
The market's going to close in a minute.
Yeah, the market's, we're coming towards the close anyway. So it's, we expect volatility. And what you will always see is this inrush of volume in the start. The volume will then settle, and you will also get a huge pickup in volume towards the end of the session, generally in the last sort of 25, 30 minutes. So you see 25, 30 minutes at the start, big volumes, lots of volatility, similar at the end. And the reason for it at the end, particularly this is Friday, we've got options expiring, we've got zero DTEs all over the place, millions of them, tons of volume, and end of the week. So there's a lot of squaring of positions towards the end of the week. So you do get a huge amount of volume coming in. Just to pick up one or two other little lessons from this chart, which is not great from a trending perspective, but it gives you an idea from many different perspectives. This was the candle I think I was going to talk about next, which was a reverse, if you like, where we've got a very big widespread down candle, and yet the volume associated with that doesn't look sufficient. It doesn't look right, because when you look at other candles in the group, and you look at something like this one, for example, or maybe some of these over here, to move that amount, that price spread, this volume looks suspiciously light. In addition to that, you've also got a wick to the lower body. So there is some buying coming in there. Now, what's interesting about this sequence of green candles here, this little sequence of 4, this is one of the most powerful applications of volume price analysis. And the reason it's powerful is because the hardest thing to do in trading is to hold a position once you've got some profit in it, because what we all do is we all bank that mentally, and then we start to see the market reverse against us, and that profit that we'd mentally banked starts to dwindle. And we start to panic, and we close out on emotion because we're frightened. We don't want to lose something that we've already banked mentally. And that is the biggest emotion that we have to battle. The reason we have to battle it and find tools and techniques to deal with it is because if you cannot hold a trend to maximize whatever is going to come out of that trend, the potential from that trend, then if you take 10 trades and 7 of them are losers and 3 of them are winners, that is absolutely fine, provided those 3 winners are relatively large and the 7 losers are relatively small. The problem is, if you cannot maximize those large winners on those 3 winning trades, then ultimately you're going to stand still, or your account's going to go backwards, basically, because the losers will outweigh the winners, because you can't maintain that trend and maximize what the potential from it. So what you're seeing in this little reversal, let's suppose this was in a price waterfall and you start to see this happening. What you're seeing here is a rally which is on very, very low volume indeed. And what that is telling you loud and clear is that, first of all, this rally is not going to go very far. And secondly, the spreads are also communicating that. So we always look at the spreads and we look at the associated volume to get a clue on whether that rally is really going to reverse from a primary trend to the downside to a primary trend in the upside, or vice versa, because the killer in terms of emotion are these reversals and pullbacks, which happen in all trends. You cannot have a straight line trend. Never happens. You go down, you pause, you pull back, you go into congestion, you go down in another leg, and so on and so forth. And it is one of the biggest applications, or one of the biggest benefits of volume price analysis, which is absolutely essential to hold you in a position to maximize it. It will kill that emotion. I'm not saying it kills it completely, but it will dampen it, is probably a better description. It will dampen that emotion of getting out. The second thing that volume price analysis does for you is that it kicks your brain into an analytical mode for those few seconds when you're just analyzing the chart and out of an emotional mode. So your emotional response is calmed. You go into an analytical mode, you process it, you maybe look at three different time frames to kind of cross-reference it. Then you may ultimately take the decision, well, actually, I think it's going to reverse. So fine, that's fine. But at least you've made that decision on rational common sense and not on an emotional trigger. And that's the power of VPA. Got another little example here, reverse example really of this one, but you've got a nice little candle here, decent volume coming in there. You know, we've had a run up, but again, the volume doesn't look particularly strong. It is rising, but then we get these very low volume bars here, extremely low. You know, this doesn't look as though it's going to go very far. The next one's punctuated with relatively high volume weakness. Just have to wait and be patient, and then we roll over. We get another big surge of volume here. Is this going anywhere? No, because there's lots of volume going in there. The candle's closed up. It's closed with a red body, but it's actually trying to rise. So it's risen, fallen back, and closed below the high of that open, if you like. But the volume there is telling you, well, it's not going to go very far. And ultimately, we roll over into this phase of price action. And now we're coming to the end of the day. But in that breakdown there, really nice price waterfall, lasted, what, 4 or 5 minutes, rising volume, falling price. That's what you want to see in a price waterfall, because it takes as much effort to fall. Remember, markets don't fall on falling volume. And again, if you see that in a trend, if you're in a short position, if you're in a long position and the market starts to reverse against you and the price action's falling, but volume is falling with it, then remember, that is weak. That's an anomaly. That reversal is not going to go very far because it hasn't got volume driving it. The volume is falling with the price. If it's going to reverse, you want to see rising volume, and you haven't. You've got falling volume. So again, it's just a very, very powerful technique to apply, and it's something we practice because of that single reason, because it helps with the mathematics of trading. Let me just move something out of the way, which just suddenly appeared. Right. Pop over onto Apple. Let's have a quick look at Apple. This is what I've got set up on this chart. I've got 3 time frames. They're identical on the top line and the bottom line. The reason I've got that is because I've got the VRSI indicator on the top line, which is the volume relative strength indicator. And I've got I've got the volatility indicator on there as well, but I've just got straight volume on the 3 charts below. So what you're looking at is identical top and bottom. The only difference is we've got the VRSI indicator on the top line and we've got volume on the bottom line. So if we just pop open the 1 minute there, just move that out of the way. This, gosh, I tell you, you get all these things that keep moving around. There we go. That's it. Fine. Let's just pop that up a little bit. In fact, let's go to a slightly slower time. Let's go on to the 3 minute. Let's have a look at Apple there. See how we did today. Let's pull that down. There we go. Okay. Just gives you a better idea of what went on today. There we go. This was around about mid-afternoon, 4:30. The US markets for us, just for reference for yourselves, the US markets for us, we're in the UK, so the US markets for us open at 2:30. So this is basically at 16:30. It's 2 hours after the open. And what I wanted to show you with the VRSI indicator, we've developed it in the last few months. I think we launched it, where are we now? We launched it early part of this year, released it tied into stock program as well. And it ties in beautifully with the volume price analysis methodology, because what this is looking at is looking at the relative volume associated with any move. And what it does is it really presents the pressure associated with any trend or lack of pressure, of course, when we move into congestion. So what it gives you is a sense of the momentum associated with any trend as it develops. And I'm sure you get the principle of it. It's very simple. When we're above the fulcrum, the midpoint line, we're in bullish territory. And when we go to the downside, we're in bearish territory. But the other aspect to it, which, as I say, ties into this whole business where we're always looking at the height of things or the lack of height of things in the volume price relationship, our volume price methodology. We also do the same here, because what you see represented by the height of these bars, the pure height, is giving you an indication of the strength of pressure that is being applied to this momentum. In other words, does this momentum have some oomph to it? Has it really got some strong pressure driving it? And really, that's what is described visually here for you with these different colored bars. And the taller they are, then the greater the pressure. And naturally, as you can see, when we move into these little sideways, it drops away a little bit. But as long as it stays above that line, then it's really giving you a strong clue that the pressure is being maintained. Now, what you also see is as we start to get ever higher and we get towards the top of this trend, these are starting to fall and telling you quite clearly that the pressure in that trend, and we'll look at the volume associated with it as well on the 3-minute, but the pressure, in other words, the momentum behind that trend is starting to dwindle and it's starting to fall away. And then we move into this region here where we go into sideways congestion. The height of the little bars is very small, so it's just reinforcing for you again that we are in a congestion phase. We would have levels there. We'd draw levels, or we'd have an indicator that applies the levels, but very simple to draw levels there, as we've talked about in terms of congestion phases and break away from congestion phases. And then as we break away from that, what's interesting about this is that yes, we move to the downside. Yes, we have rising bars, but they're nothing like as tall or extreme as these, for example. So it tells you that, yes, we have some bearish momentum here, but that bearish momentum is really not very strong. And you can see how it, again, really didn't get very tall, those bars, and we start to diminish as we move back into the congestion phase, which has really extended out towards the end of the session. So if I just pop that one back, and I'll just concentrate on the 3-minute here down here as well, just pull that down there. And really that's reflected, if you like, in the actual bar by bar reading that we would do in terms of volume price analysis, because you can see for yourself how much volume is associated generally in this region with this trend higher. So the VRSI is really giving you a graphical representation of the relative volume that is coming in bar by bar on the price action, and therefore the pressure associated with that move. Now, what's interesting as we look at this from a VPA perspective, pure VPA perspective, the candle that catches your attention is this one. And look at this. We have a very narrow candle, but we have very high volume, certainly as high as we've seen here. So if you looked at any of these candles, look at this one, for example, and say, well, if that was my benchmark candle, then the volume is in agreement, yet the price is in disagreement. So what is happening here? Again, back to the same principle. It's Wyckoff's third law, effort and result. We're putting in a lot of effort, but we're not getting much of a result. In other words, the spread is narrow. So what's happening here is we're putting loads of effort in, and that is not being seen in the price spread, because if this were true, if this were genuine, we should expect to see at least something like this, one of these, for example, and we are not, because the volume is actually taller than that. We are seeing a very narrow spread. Therefore, no great surprise when we see this. What's interesting about what follows through is it really doesn't follow through with any great degree of momentum there either, because, as I mentioned, we've got, if we see falling price and falling volume, it's anomalous. So in this case, we've got two candles, falling volume, spreads narrowed. And again, this is another facet when you're looking at, particularly in price waterfalls, you want to see widening spreads, because if you think of it as a waterfall, initially it will start with one spread, then that spread will widen, you'll get another one widening still, and then maybe you get some stopping volume in and so on and so forth. But in that falling process, if you imagine a waterfall in your mind's eye, you expect to see it tumbling as water does. And you would expect to see that reflected in the price bars as well. But they're not. It's narrowed. So we've had a decent start, and you might look at that and think, oh, okay, perhaps we're going to start the waterfall now. But we move to the next one and the volume's fallen. It's in alignment with the spread. It's not anomalous in that sense. But what is anomalous is the fact that the price has fallen along with the volume. So we don't expect much to happen. This candle comes along, that looks okay, volume and price in agreement, fine. But then look at this little rally. This reverses, and we're looking at this thinking, well, look at the volume here. We've got tiny little candles, virtually no volume going on. Is this going anywhere? Absolutely not in a month of Sundays. Why? Because it hasn't got any volume. And in addition to that, these spreads are tiny, really, really small. And that sort of pattern of dialogue, if you like, continues. Look at the volume here in the middle here. Up and down, not really going anywhere. And the same applies to the red candles, down candles, really not going nothing, absolutely nothing. It is only when we get to the end of that phase of price action, and you'd put a level on here and you'd have one up here somewhere, maybe something like that, that we finally get an increase. So here we start to see only three candles, I appreciate, didn't develop very far, went to that one. But look at the reaction. We get the first three, rising volume. So we know that is a genuine move. In other words, volume and price are in agreement. The third candle, what's interesting, the spreads have narrowed a bit there. So we've got higher volume, but we've got a narrower spread. So that's slowing a little bit, because ideally what we would have wanted to see on that third one was down here somewhere. And it isn't. It's compressed. It's squashed. Why is it squashed? Well, there's buying coming in. So we expect to see a little bit of reaction, or a pause point at the very least, because some buying has come into the market. We don't care why. We don't care where it's come from. It just has arrived. We've got some buying coming in. The reaction to the green candle, let's suppose we were short. Would we be terrified if we saw this? Absolutely not at all. Why? Because the volume is very low. We've had a reaction, but it's virtually no volume there. It's very low volume, and we're back to this sort of volume here. So if we're short, it would give us encouragement to stay in that position. You wouldn't be flicked out on the emotional trigger of, oh, my profit's gone, I've got to close out, get out, get out, get out. This doesn't go very far, I appreciate, but to use it as an example, it is a good example, because on the next three, we're back to price and volume being in agreement, because we have a falling price rather, generally widening spreads. Similar sort of event as before, where this third candle narrowed again. So again, no surprise to see a reaction back up again, and on we go. And that is the dialogue that you have constantly. We are processing that. We are reading the chart. We look at the spread of the candle. We look at the wick of the candle, and we look at the associated volume, and we interpret it accordingly. I'm just reading one chart here, but we could do this across multiple timeframes, and that is what we teach in our coaching sessions and mentoring. And all of our mentoring students, we start with volume price analysis, because if you haven't got that bedrock of methodology in place, it doesn't matter what you're going to do, you will struggle. So we spend a lot of time doing that, a lot of time going through charts, reading charts, and then we start to build the process into teaching them how to trade and to make money. And I have to say, we have some very, very successful students. We have one in particular, trades on very fast timeframes and takes 4 figures out of the market on a regular basis with 10 or 11 trades a day on the scalping side on indices. And that's the sort of money that we want you to make as a student of ours. So if you're interested in the coaching program, you will find the details over on Anna's site. I'll show you where that is if I can. Let's see if I can. Not sure if I can move to another screen without stop.
You have to stop sharing.
Probably stop sharing. Yeah, and go to another screen. Just pull that up very quickly. No, I have to get the screen first. Let's get rid of that for a minute. Go into this. There we go. Close that down, I think. Where are we? Yes, that's it. I think I'm sharing that one. Is that right? Hopefully that's the one.
I can see it, yeah.
Yeah. This is where you will find Anna's site at annacooling.com. And if you are interested in the coaching, then you'll find the register here. And you will have the way we run it is very simple, because we don't believe in group coaching, because you're an individual trader and you are unique, and therefore the approach that we develop for you will be what suits you. It's based on what we believe will work for you, and it's tested with you and developed with you over the sessions that we run. And that process all starts with an initial free conversation with either Anna or myself or one of our colleagues. Have a 30-minute chat with them and talk through the issues you may have, what you want to learn, how you want to trade, how you want to invest, whatever it may be. And if there's a good fit, then we will take it from there and join us. I just have to say, we don't take everyone, because this is a huge commitment, not only for us, but also for you. And we have to be sure that you have the, what's the word I'm looking for? You have the determination to succeed, because it's
uncomfortable. Your brain will ache.
Yes, your brain will ache. It will hurt. We do have to do a lot of rebuilding work, but we pride ourselves on what we do. And if whether you want to trade on the very fast charts, or whether you're looking to invest on the slower charts, whatever it is you're trying to achieve financially, we will be able to help you get there. But it all starts with volume price analysis. And indeed, the little book there, the download, Mastering the Art of Kaizen Trading, that really explains the process of trading that we take you through when you become a student of ours on the coaching and mentoring program. So there we go. I'm going to, I'm just going to pass back to Anna. So I will stop sharing my screen and switch off.
There's just another question in the chat. So I'm saying, can we perhaps look at the ES and the NQ, because we know a lot of traders are working through, they're doing funded programs and they're on evaluation stages and what have you. And I think that's what we will do next time, if that's okay, because that is a topic all of its own. You have to, all sorts of other things that you have to know about the futures. But having said that, it's still the basic premise of volume price analysis. That is it. Once you've mastered that chart reading and you take it to a very high level, you can apply it to anything. You can apply it to futures, you can apply it to a stock, you can apply it to indices, etc., etc. Right. I just want to share, just finish off with what I mentioned at the beginning, to share with you this resource, the 30, where you can find details of who's buying what and where in their portfolio. This is from my Twitter feed, and it's they're called Carbon Finance, and they do have a site. They have an email that you can subscribe to. I think they have a paid service as well. But to be honest, if you've got a Twitter account or an X account, they're really well worth following, because you will they give you so much insider information. Now, essentially, as I said, the 13F filings are released every quarter, and they tell the world what these guys are buying, where they're invested at the moment, if they've changed their portfolio holdings in any way, have they sold, what have they sold, what have they bought, and what traders, both traders and investors, because what happens is when you get someone like Warren Buffett, who suddenly makes an investment in a stock that you would never think he would invest in. It's a beauty. I think their beauty product is called Ulta. Is it makeup, David? It is, isn't it? Beauty. And suddenly he's bought a stock into his portfolio, which most people would never think that he would consider. Traders will take advantage of that. There's practically always a boost to the price. So, if you're a day trader, great. And the stock's not hugely expensive. Why not? And obviously, if you're a swing trader, you would look at it as well. And also, if you're a longer term investor, well, it's good enough for Warren and probably good enough for the rest of it. What's also interesting about these portfolios is the approach that these guys take to how they structure their portfolio. Are they very diversified, or are they very highly focused, highly concentrated? And because there is no right or wrong answer. They have portfolios worth billions and millions. You and I can have portfolios which are a few thousand, or we're lucky enough, a few 100,000. But the same questions have to be asked. Do you want to focus on maybe one or two assets? Let's call them assets. Could be stocks as well. Or do you want to diversify your risk? And I was thinking about it, and I was thinking, well, when you probably start, if you spread across too many, then yes, you're spreading your risk, but the rewards, because they're in smaller quantities across asset classes, then that's going to perhaps take a little bit longer to grow. Whereas if you have a high conviction on maybe one or two or three, and they really do take off, then your portfolio of assets is going to increase much faster. Having said that, it's really interesting. They've put together that there are hundreds of these portfolios. There's another site where you can go through every single one, and the key is obviously to see what they are at the moment. How's it changed from the last one, and then when the next one comes along, you take it on from there. So these are the top 15. Obviously, Warren is there. He's got I think he had 2 new stocks, one of which was this company called Ulta, and who we have now. The other one was Bill Ackman. He was interesting because he went into Nike. Nike's had a bit of a rocky road lately, so that's been quite an interesting that sparked a lot of interest, if you like, from traders and investors. I think Bill Gates has sold some Microsoft. And you can see, I'm just going to scroll through them very quickly. There's Michael Burry. I think his portfolio has not been doing very well. Chris Hone, he's a British guy over here in the UK. Some people you probably never heard of, but I can assure you they're worth a lot of money, and so on and so on. And I really just wanted to highlight, first of all, carbon finance. Secondly, look at this, their approach to the markets in terms of concentration or diversification. Of course, it also depends on the amount of money that you have in your account. This guy, I think, was mentored by Warren Buffett. As you can see, he has a very highly concentrated portfolio. And this guy is really interesting because he's actually only in he's only in four assets. That's really interesting. But assets under management, he's only got 233 million. And I think that kind of answers the question that that I posed earlier on, and so on. And so where's my favorite one? There's Stanley. Stanley seems to be all over the place, but he's got 2.9 billion. So, you know, good luck to him. Terry Smith, he's another the British guy. He goes back there. Anyway, that's something for you to consider. Now, I'm just going to stop sharing because I have to change tabs, and then I'm just going to wrap it up. And I've got, let's have a look, Ulta. Okay. Right, so this is the stock. And you say, well, is there any way that we would have known? Well, the short answer is no. You may have had this stock on your radar from a just a technical analysis perspective. It probably would have cropped up because it was quite sort of oversold, as it were. And as I said, this is the weekly chart, and we can see here, what was it? Ulta Beauty. I told you, yes, 500 expensive stock, 560. It's been in this. We had this. It's been in a downtrend. We've had this consolidation. It actually broke through this quite very strong platform of support here, and down it went over the last 1, 2, 3, 4 weeks. Now, getting back to what David was saying, we have a very nice VPA lesson here where we've got falling prices over the week. We've got a high volume, but look, we've got this narrowing spread again. So just from forget about what Warren's doing and you know the 13F filings, from a VPA perspective, that would have been something to watch out for. You think, yep, something is happening potentially. It's obviously been now given a boost by the fact that he has now invested in this company. What's interesting, a lot of volume, but it's also triggered a volatility trigger. So we'll see if it actually is going to go higher next week. It's at in the aftermarket, it's up at 377, or whether we're going to see a little bit of congestion in that within the spread of the candle. And it's also gone back to this support level, which now becomes a ceiling of resistance. And we can just draw a quick, let's have a look, a quick line here. So there we are. I have got a level here. It's not terribly strong. It's gone back to test that level there, which is now resistance. So if we scrunch the chart up, we can judge how many times it's actually bounced off there. So if it's going to go higher, it's got to go through there. There's a lot of volume under there, but that volume's got to continue and see whether it can actually make that 560 again. And then very quickly on Nike. There we are. What's happened with Nike? Let's have a look. The month. I can't remember with Nike whether it's the week or the month. Let's have a look. Yes, it was the monthly chart, which was really, really interesting. And these longer term timeframes, even if you trade the faster charts, they can give you, as I said, some indication of what to expect the following week, the following weeks, as it were, just for review. It's not to be taken right. Well, I see one signal and I'm going to, and I'm going to go in one direction or another, but it just sets the context of the price action on these timeframes that will have a direct impact on what is going on the faster timeframes. And I think this is probably the clear. Do you like this chart, David? Yes. This is Nike. As I said, Nike's had a bit of a rocky road, but what did I say earlier? This is the signal. This was last week. Pardon?
Absolutely.
This is, if you see this signal, that one, and you can see it's been selling off, try to rally sideways, sort of drifting down again, traded around here. I think this is where we also had the volume point of control, a further drop down, and then bang, this tiny candle with a massive volume underneath it. So what does that tell you? That tells you there has to be buying in there. And obviously it's been given a bit of a boost from what's happening with the news on the 13F filings. But the clue was already there with Nike, that Nike may have actually regained some kind of a stabilization. What we see with these candles, yes, they can be reversal candles, but they're also, they give some stability back to a stock that has really suffered. It's come down from 100, 180 all the way down to $80, so 70, 60, $65, $70, $70. That's painful, especially if you bought up here and it's in your portfolio. And now what happens is you have that, you've got that stability. What tends to happen, particularly with stocks that have sold off very, very heavily, is you will have a lot of investors who are stuck at these levels, who didn't sold out. And as soon as the stock comes back to maybe a break even or a $1 profit or $2 profit, they will cash out and say, oh, thank goodness I got out of that stock. Which is why when you have these reversals in these what we call fallen angel stocks, the move higher always takes time, because as the stock moves up to different levels, you will find people coming, that have been the bag holders, they're called, I think rather cruelly, that didn't, that have held on and held on. And when the relief that the price is back to where they get in, and that obviously holds the price up. Now, I've not gone into, these characters are buying great blocks of stock, millions and millions of stock. How that business is conducted, it's not conducted in what's called the lit exchange. That's when you and I are in there. It is conducted after hours, before hours, but eventually those block orders, they have to be reported. They do appear in the volume bars, because we're often asked to say, oh yes, but there's so much that goes on behind the scenes. Someone who wants to buy 30 million of Nike, if they go and try and buy 30 million of Nike, I want to buy 30 million of Nike, the price would shoot up. They want to buy at the best possible price. The market makers, to be fair to the market makers, they have to conduct what they call an orderly market, except when it suits them not to. Is that a fair comment, David? So that's my last comment on that. Right. Anything else you want to say? You want to pass on to you? Fine. Any more questions? That's it. I think we've answered all the questions. Thank you so much for staying with us this evening. I hope you've enjoyed this session. As per the request in the chat box, we will look at the ES and the NQ next week, probably the YM as well, one that's not often traded, but can actually deliver some very, very, very nice trades. So I hope you will be able to join us. It won't be on a Friday. It will probably be next Thursday, possibly. But it will be towards the back end of next week, simply because we've got a couple of days break early part of next week. We're going to a very nice wedding in the south of France. So, we are looking forward to it. So thank you again for joining us, and have a great weekend. Have a great trading week next week, and we will see you next time. Oops. How do I close it? Oh, it's me, isn't it? Hold on, I've got to stop sharing. Apologies.